So let me highlight 4 related developments. First is the increased scale of Treasury issuance. The US budget deficit is forecast by the CBO to be almost $2 trillion this year under current law. This must be financed with new debt issuance, and a growing share of existing debt is in short-term T-bills, which need to be rolled over every year. This combination makes the US Treasury market much more vulnerable to shocks, even if they're just short-lived. Second is the more limited ability of broker-dealers to intermediate between buyers and sellers in the Treasury market, as we've already heard about from the other people today. The capacity of this middleman has simply just not kept up with the increased size of the Treasury market. And this limited capacity could lead to illiquidity, less efficient pricing, volatility, and spikes in borrowing costs. Third is changes in who is purchasing US government debt and how they're doing it. Foreigners are purchasing less, balanced by US institutions purchasing more. Many of these US institutions are hedge funds and asset managers that are not simply buying and holding treasuries, but using a combination of repurchase agreements, futures, derivatives, and hedging strategies combined with high leverage. These developments have benefits and costs, but one risk is that these highly leveraged investors are more prone to the fire sales that trigger market dysfunction. Fourth and finally is shifts in geopolitical alliances and the increased restrictions on trade and financial flows. This could, over time, reduce the demand for US dollars and treasuries. To date, the dollar and treasury market is still dominant, undoubtedly because all the other alternatives have their own challenges. Nonetheless, if foreigners do become more concerned about potential losses, which could occur from high inflation, dollar depreciation, new taxes on their holdings, or restrictions on their ability to buy and sell, this could trigger sudden sales, a sharp dollar depreciation, and increased borrowing costs for our constituents. That's not enough to worry about. Monetary policy also faces an additional set of challenges. Disruptions to trade and supply chains will increase both inflation and unemployment. And central bank independence is under pressure in many countries around the world. An independent central bank will not be able to avoid painful economic adjustments, but can stabilize inflation more quickly, limit the extent of price increases, and require fewer job losses. So to conclude, we are at a historic moment. The global trade and financial architecture is being transformed. Periods of transition create opportunities, but can also aggravate underlying risks and vulnerabilities. The risks to the Treasury market are particularly large today, given the sharp increase in debt and other developments I've highlighted. And any disruptions in the Treasury market will impede the ability of the Fed to stabilize inflation, support employment with moderate long-term interest rates. So the committee's work today has become even more important than just the 2.5 months ago when you were formed. I look forward to your questions.